single most useful thing a new mortgage broker can learn before CMAP theory, before lender panels, before sales scripts is how to think like an underwriter, because every case that you will ever place is decided by someone sat in a lender's back office looking at your application, asking one very, very simple question. Am I comfortable putting this lender's money behind this borrower? And here's the truth about this one. Every decline that you'll ever get in your career comes from you not thinking that question through before you submitted it. That's it. That's the whole game. Case selection, packaging, preempting concerns. That's what separates the brokers whose cases sell through underwriting from the ones who spend year one on the remedial supervision wondering why nothing seems to land. This video is that thinking, what underwriters are actually looking at, what kills applications, and how a beginner broker can preempt problems before that case ever goes in. Now here's why this matters and why I want you to actually pay attention. Every declined case costs you three things. It costs you time, hours of research, packaging, and client management that now has to be redone with a different lender. It costs you money because the client's confidence drops, the estate agent starts looking twitchy, and the cases you got declined once are meaningfully more likely to fall apart entirely. And it costs you reputation because the client doesn't know that the decline was avoidable. They just know their broker put them into a lender that said no. The brokers I've watched thrive in this industry aren't the ones with the biggest lender panels or the fanciest CRMs. They're the ones who learned early to think like an underwriter, to look at their own cases before they submitted it and asked honestly, is there anything here that is going to make the person on the other end of this feel uncomfortable? Learn that habit in your first 6 months and your decline rate is going to drop through the floor. Skip it though and you'll spend a decade blaming lenders for all of the problems that you created yourself at the packaging stage. Now let's start with what an underwriter actually is, because most new brokers picture them as some kind of faceless, bureaucrat kind of person looking for reasons to say no, but they're not. Underwriters are risk managers. Their job is to protect the lender from losing money on bad lending decisions. And to do that, they are looking at your case through a specific lens of how likely is this borrower to pay this mortgage back over the whole term without ever it becoming a problem. Everything they check, income, credit, affordability, deposit, property, it feeds into that one question. And the more clearly you can see the cases through their eyes, the more likely that you are going to package it in a way that answers their concerns before they've even raised them. The best brokers I know, they don't submit cases and then just hope and pray. They submit cases, the mental note attached that says, here's why this fits, here's the bit that might look a bit odd, here's why it's actually fine, and they package it all accordingly. That single mindset shift is what separates the brokers who get a first-time yes from the brokers who get a query email 48 hours into the submission. Now, the first thing underwriters often look at, and the biggest single reason cases get declined, is income. And the mistake most new mortgage brokers make is treat income as one number rather than understanding how lenders actually break it down. For employed clients, the picture is genuinely super clean. Pay slips, P60s, employment contracts, most lenders they'll accept 100% of the basic salary. Where it gets a bit complex is where variable income comes in. So overtime, bonuses, commission, shift allowance. Some lenders will accept 100% of this, some will accept 50%, some will accept an average of the last 3 months, some like the last 12 months, some ignore variable income entirely. Same client, same income, wildly different affordability results depending on which lender that you pick. Now, for self-employed clients, it gets even more nuanced still. Sole traders are usually assessed on net profit, averaged over 2 or 3 years. Some lenders, they'll take the most recent year. Some lenders, they'll average them. Some lenders will look at the lowest. Limited company directors, again, they can be assessed on salary plus dividends. Or even with some lenders, salary plus retained profit. And that single distinction can double the amount that they're allowed to borrow, and it depends entirely on the lender. Contractors, day rate workers, foster carers, people who receive benefits, pension income, rental income, every single one of those categories has a specific set of rules per lender, and the criteria changes regularly within those lenders. The broker that understands which lender treats which income type most generously is the broker who gets deals through that other brokers just can't seem to place. The rule for beginners is simple. Never assume income is straightforward until you've verified it with documents and checked how the specific lender that you're applying to treats it. Most declines on income come from the brokers who didn't check the criteria before recommending the lender. The second big area that we need to discuss here is credit. And this is where new brokers get blindsided most often, because clients genuinely don't always know what's on their credit report until you actually run it. Underwriters look at the credit through several lenses. What's the credit score, roughly? Are there defaults? And if so, how old and how much? Are there county court judgments? Is there a history of missed payments on any credit accounts? What's the current level of unsecured debt? How much of available credit is being used? The utilization ratio across that. Are there any recent hard credit searches suggesting the client's been shopping for credit elsewhere? Different lenders have completely different tolerances for each of those things I've just mentioned. Some are really strict on defaults over 3 years old. Some ignore defaults under £500. Some are really relaxed on CCJs from more than 4 years ago. Some care really deeply about credit utilization above 50%. See, there is no universal credit standard. There's each lender's individual policy, and it changes as their appetite for risk shifts through the market cycle. The single most important discipline here, the one that I've hammered onto in so many other videos, is to run the credit report before you research any lenders, not after. Not when the client sends the other documents, before. A credit report will surface things that the client either forgot or didn't actually realize counted, and it lets you pick a lender whose criteria actually fits the reality of that client, not the version of reality that the client remembers. Once income and credit score are established, the underwriter runs an affordability calculation, and this is where beginners get really frustrated because two lenders looking at the exact same client's income and outgoings often produce completely different maximum loan figures. Now, the reason for this is that affordability isn't a single formula. Every lender has their own stress testing methodology. Some stress test at a fixed rate, let's say 8%, even if the actual rate is much lower. Some stress test at a pay rate plus a percentage. Some use income multiples as a hard cap. Some allow different multiples depending on income level. Some are more generous on child benefits. Some are stricter on childcare costs. Some even allow you to add back pension contributions, some don't. Same client, same income, same outgoings, and one lender says 280,000 maximum loan, another says 340,000 maximum loan, and another one says 220,000 maximum loan. All of them are technically correct. They're just running completely different affordability models. And the skill of a broker is knowing which lender's affordability model actually favors the specific client that you've got in front of you. And the only way to build that skill is by running affordability calculators on cases over time, seeing which lender consistently offers more on which client type, and building your personal knowledge base from experience. Now, quick pause here. If you're watching this and thinking, actually, I'm past all this beginner stuff, I want to know how established brokers use lender knowledge to genuinely grow their income and build a serious business, then that's not what this channel that I create is for. This channel is for people starting out, but I've got a second channel called the Mortgage Business Mastery Show, where I put out a weekly video specifically for established brokers who want to build, scale, and get seriously good results. So sales, retention, systems, hiring, the whole picture. If you want to get a head start and see where this career actually leads to once you're properly running, the link is in the description. I'll also pin it in the comments too. Check it out when you get a minute. Anyway, let's get back into the video. Now, once the application is in, one of the first things underwriters do is read the bank statements, and most new brokers underestimate how forensically they are going to read them. They're not just checking that the salary lands, they are looking at so many other things. They're looking at spending patterns. Is there evidence of gambling, regular payments to short-term loan companies, overdraft usage that suggests the client is stretched, direct debits for credit facilities that weren't declared on the application when it was submitted, regular transactions that suggest undeclared financial commitments to family members, deposit money appearing suddenly with no obvious source. See, every one of those things is a potential red flag, and they can turn a case that looked clean on paper into a decline once the underwriter actually reads the statements. The way to preempt this, though, is to actually read your client's bank statements yourself before submission. What a shock. Not skim them, read them, line by line. If you spot something that would make an underwriter uncomfortable, either address it in your notes to the lender or reconsider the lender you are actually placing the case with. Because underwriters will find whatever you have missed, and by the time they find it, it's a decline, not a conversation. Now, underwriters take deposit source seriously, and it's another area where beginners quietly cost themselves cases. Every pound of the deposit has to be traceable and legitimate under money laundering rules. So money that appears in an account within the last few months has to be able to be explained as to why it's there. Gifts from family members require gift letters, and depending on the lender, sometimes proof that the donor owns the actual source of the funds. Concentrated savings from long-term accounts are usually the cleanest picture when it comes to getting a deposit. Gambling winnings, cryptocurrency proceeds, and cash deposits are all areas where lender policies vary significantly as well. If the deposit picture is complex, gifted deposits, contributions from multiple sources, recent inheritance, sales proceeds from another property, the broker needs to know before the research begins, and needs to pick a lender whose deposit source policy accommodates the specific situation. Cases that get declined at the money laundering stage are almost always cases where the broker didn't ask the right questions early enough. The property itself is the security for the mortgage, and the underwriter also has to be comfortable with what they're lending against, which means that the property has to meet the lender's specific criteria. And this is where a lot of cases get declined again that had nothing to do with the client at all. Different lenders have different rules on things like flats above commercial premises, ex-local authority properties, timber framed and non-standard construction, properties on private roads, cladding issues on certain flats, certain leasehold terms as well. Some lenders, they won't touch particular postcodes. Some cap loan to value on new build flats. Some have restrictions on multiple unit freeholds. The client can be perfect on income, credit, affordability, all of it, and still get declined because the property itself doesn't fit the lender's criteria. The way to avoid this is to check the property's details at the research stage against the specific lender's property criteria. Every lender publishes their acceptable property policy. It takes 10 minutes to check, and it saves cases that would have otherwise died at the valuation. Now, because this is a common search term, the beginners often get confused about this. The difference between soft and hard credit searches. Now, a soft search is where a lender or broker checks the client's credit file without leaving a footprint that other lenders can see. It is used for indicative decisions and to check eligibility without affecting the client's score. Most decisions and principles these days use soft searches, which is why clients can shop around without immediately damaging their credit file. Now, a hard search is where a lender formally checks the client's credit file as part of a full application, and it leaves a footprint that other lenders can then see. Too many hard searches in a short space of time can genuinely lower a credit score and make future lenders nervous because it looks like the client's been shopping heavily for credit and getting turned down. The rules for brokers is simple. Only trigger a hard search once you've genuinely confident the case is going to fit. This is not a fishing exercise because every unnecessary hard search you trigger is a tiny hit on the client's file. And enough of them stacked together can materially affect the outcome. Now, here's the frustrating truth every experienced broker learns eventually. Sometimes a case looks absolutely perfect on paper and it just still gets declined. And the reason usually comes down to one of a handful of things. The lender criteria changed without any warning. So a policy that accepted the case last week doesn't accept it this week. And underwriters have discretion. One underwriter's judgment call goes one way, another one goes the other way on a borderline case. Property valuations come back in below expectations. Changing the loan to value calculations and automated affordability models get updated overnight and produce a completely different result the next morning. Lender appetite shifts as well through the market cycle, and the lender that was hungry for new business 6 months ago pulls back when the economy starts to wobble. None of these things are the broker's fault, and they'll happen occasionally, no matter how well you package a case. What matters, though, is having a plan B. If your first choice lender declines, which is your second choice? Which is your third choice? See, a good broker isn't picking the best lender at submission. They are mentally holding a short list of alternatives in the case the first choice doesn't actually work out. See, the habit that separates good brokers from great ones is all about preempting everything, not reacting to declines after they happen, anticipating them before they do. A preemption checklist looks like this. Before you submit any case, ask yourself questions honestly. Have I got every document that I need, including the credit report, actually in my hand? Not promised. Have I checked the lender's specific criteria for the client's income type, credit history, deposit source, and property? And have I read the bank statements line by line for anything an underwriter would actually query? Have I packaged the case with clear notes explaining anything that might look unusual? Have I got a plan B lender if one doesn't land? See, it's 5 questions, 2 minutes to run through, and they'll catch 9 out of 10 of the things that would have otherwise potentially caused a decline. The brokers who ask them are the ones whose cases fly through underwriting, but the ones who don't are the ones who spend year one wondering why their first time acceptance rate is so much lower than everybody else they know. That's the game. Think like an underwriter. Look at your own cases through their eyes. Preempt every concern before you press submit. Do that consistently and your decline rate is going to become a rounding error. Now, once you understand how underwriters actually think and what they're looking for, the next thing to sort out is the structural side of running your business as a self-employed mortgage broker, because none of this knowledge matters if the business behind it isn't set up properly. And that's the video that's on screen right now, the Self-Employed Mortgage Broker Guide to Tax. The framework every new self-employed broker needs to to think about when it comes to business structure, VAT, tax discipline, pensions, and the questions to ask an accountant before you actually take on your very first case. Watch that video and make sure to hit subscribe while you're there.